Hey, everybody. I get lots of calls from at least local agents around commercial, and I'd be more than happy to continue to take your referrals. But I thought what would be a nicer thing to do is to give you the basics because you're going to find that commercial is not all that much different than residential. And the things that they do in commercial from a cap rate perspective, some of the different things that you need to understand that are a little different than residential. We're going to walk you through some of those basics today to help you with a listing or a purchase of a commercial property for a client. Moreover, it's really important that you have the right partners. So I brought on the line today with me Robert Shaar. Robert has a amazing resume. He worked closely with the NHL. He's building amazing buildings, including hockey rinks for the NHL, hotels, office complexes, malls, you name it. Robert is building it. Not only that, he's the former CEO of HSBC Canada, that little bank that does a lot of commercial lending. As a matter of fact, it's funny. I was yesterday on the line with a lady from Scotland. We're financing a 16 million pound transaction for a gentleman in Scotland, which is 20 million US. And gosh darn it, if they didn't know Robert Shaar, because HSBC is where the lady came from. So Robert is famous worldwide, not just here in North America when it comes to the commercial lending space. So what we're going to do is try to make this interactive and get you the education that you need so that you're not afraid of commercial transactions, that you're willing to take them on and make a couple extra bucks this year. Also, I don't know if you know this, most other companies don't let residential real estate agents do commercial. However, we do not have that restriction. Now, what I would say is, don't go in without the right partners. Take myself. I know Paul Frank is a big, proponent of commercial in the space here at EXP. If you took myself or Robert Shaar is a commercial lender. He's fantastic in the commercial lending space. So we're going to share his contact info a bunch of times. If you want to share no commissions and have a ton of assistance, I'm sure Robert would coach you along the way. And then you're not sharing commissions with another real estate broker. You're just actually partnering with a gentleman that knows the commercial lending space, and he can help you with a buyer. On the listing side, you're probably not going to be working, at least with Robert, on financing a purchase. So you want to ping me or, Paul Frank or somebody else that has some commercial experience. I'll help you for free. If you really want to hand it off and give it to me, I'll for sure give you a referral. But let's see if we can't make you comfortable today. Any questions before we get rolling? And Robert, you want to share a little bit about yourself before we get rolling? That would be great.
Yeah, sure. It's a pleasure to be on the call with everyone. It's interestingly and serendipitous that I see Patrick, James, and Courtney Swift on the call. You don't know this. Well, Patrick Russell does, but had the opportunity to meet them in Colorado. And as Russell mentioned, I've been very blessed in the real estate space. I've been lending for over 28 years with HSBC, moved into the U.S. in 2001. I got my citizenship about 15 years ago. So all my U.S. friends that have tried to call the INS have been unsuccessful. I'm here to stay. And you guys and gals are pretty much stuck with me. But got into the Raleigh market in 2013 and had some really interesting initiatives. I started buying land and not really understanding what I was doing in the commercial space. Got involved in the development on my own. And I'd say 10 years later, it's not just been an unbelievable experience for me and for my family. The legacy planning that we're enjoying nowadays because of the commercial shift has been extremely enjoyable and a lot of fun. And I encourage everybody on the call to Russell's point is to really utilize the professionals who know the space, lean on them as you go through the process. Don't be shy to ask questions. Russell is one of those crazy guys that works Monday to Sunday, like me, unfortunately. I'm still married and my wife loves me. And basically the long story short of it is, we are available when you're working, we're working. So don't be shy to reach out. Our platform, and to Russell's point, is a marketplace that just touches every single asset class you can think of. If we've got to go down to 500,000, we will. But I've recently closed a $195 million ground up hotel construction deal at SoFi Arena where the Rams play. So we have access, scope, scale. we've touched every asset class, and I'm really excited to make sure if anyone has questions or needs support, that I'm available if you guys need me, and here to support Russell. And I didn't know he had 200 warriors working under him, so that changes my perspective of Mr. Russell Inyard. So he's a bigger baller than I realized. So congratulations again, Russell. That's a big number.
Hey, I will trade the 200 for your paycheck on that $195 million transaction. How about that? Hey, so let's jump in. We're going to cover property types, lease structures, valuation, and financing. What I'll tell you is income is everything in the commercial space. I have an example of a property that we had in Illinois. It was an old Motorola factory. We couldn't sell it for $20 million. We put a federal backed leasee into the structure, and then had no problem selling it for $150 million. So again, couldn't sell it for 20 because there was no income. It was just a big empty space. Put the right tenant in it, and the value went from less than 20 million to 150 million. So the difference between residential and commercial is income. Whatever income you can make on the property, that actually tells you what the value is going to be. And there's all kinds of commercial property. You think about industrial, office space, medical, malls, you name it. There's all kinds of different property types. Lease structures are ridiculously important with regard to valuation. We're going to go through gross, net, triple net, and true triple net leases. And then we're going to talk, of course, about financing, which is Robert's area of specialties. So that's what we're going to be covering today. I think I did this already. We're going to talk about cap rate valuation. When somebody is going to potentially purchase a commercial property, what they often ask you as the real estate agent, well, what's the cap rate, right? And so what I'll tell you is the cap rate is usually inversely related to appreciation and quality of structure. And what do I mean by that? So if you have a property that's in, Park Place, New York, right? In some Park Place, you're on Monopoly, right? And you have a place that's going to appreciate ridiculously, you're going to get a lower cap rate, which is an annual return, because you're making your money also on appreciation. Additionally, if that building is brand new, you're going to have no maintenance costs. That's called an A-class building. Because of the A-class building, your cap rate is going to be lower. Now, let's say you have one in the middle of, and I hope I don't offend anybody, but let's say late in the middle of North Dakota, because I know we have a bunch of South Dakota people here. We have one in the middle of North Dakota where appreciation just doesn't happen, right? And the building is 35 years old. You're going to be expecting a very high cap rate, because you're going to need a nice return on your money, because you're going to have very little appreciation, and you're probably going to have some fix up on the property. So we'll talk about cap rate valuation. And then I'm going to let Robert, when we get there, talk a little bit more about DSCR loan financing, which is one of the structures that people really like in commercial. I already talked a bit about office class A, B, C buildings. Again, the nicer, newer, better location of the building, it would be considered an A class. Many of my apartment investors, they like the C's and they like to turn them into B's. They call that value add, right? Hey, is it an old dilapidated building I can buy cheaper and move it from a C to a B? I can lift up rents and make things a lot better. For example, if you bought a 500 unit apartment complex and you were able to raise rents $50 a month, your valuation of that building would go up approximately $4 million. So your net worth would change by about $4 million by a $50 a month rent increase on a 500 unit building. So that gives you an idea of, when you start to look at scale, what you can do moving something from a C to a B.
Let me throw one other thing in there, Russell, if I could. I bought a building, an industrial building in Macon, Georgia, of all places. It was empty. No revenue clip whatsoever. So we weren't getting valuation on the clip. I bought the building for $550,000. It was 50,000 square foot asset. I've spent about 70,000 in upfit. We leased it to a national tenant and I relisted it. It sold for $3.1 million. So those value adds can be really aggressive, and you don't need to go spend $100 million on something to make several million. It's really just understanding the asset, understanding how to place it, and the value add is going to get better and better as a lot of these notes come due and people can't afford the debt anymore. So very good place to entertain.
Very cool. And people ask too, hey, I want to buy, like, we'll go down to the bottom right-hand side. Hey, I want to buy land, right? What can I get from a loan structure on land? I'll tell you, it's tough. Land is a tough buy, right? So you're going to be looking at high costs, because there's nothing there yet. Even if the opportunity is fantastic, I haven't found any lenders that'll go above 70%. Most of them are going to be right in that 50% range. And I want you to look at the third category under land and special use, data centers. My goodness, it is the data center. I've been talking to too many people in different countries. Data center gold rush right now. Data centers are amazing. They are worth the value of the power on the land. So if you have any land out there, that your grandma or grandpa or aunt or uncle donated to you or left to you or whatever, and it's got, a couple hundred acres and there's unused power of a gigawatt, which is ridiculous. You're sitting on billions and billions and billions of dollars, and I can sell it tomorrow. So bring that to me. That would be good. Multifamily, anything over 5 units is considered commercial. So 1 to 4 is considered just multifamily residential. Anything above 5 is commercial. And again, most of these categories, we can go very, very leveraged, high leverage. We have some SBA products where, you're going to get ridiculous rates in the 5s right now, potentially. And then non-owner occupied DSCRs is in the 6s. That's why we have Robert on here. He can give you the actual quotes. He has the license for that. But that's what I'm seeing in the marketplace. Would you say that's about right, Robert?
Yeah, absolutely.
Perfect.
I noticed you left healthcare off that list. I like that idea.
Yeah, I didn't put healthcare in here.
You don't want to, man. It's a tough industry.
I put medical office up there on office, but yeah, healthcare is a tough space. I'll tell you what's really tough right now is office space in general. We have millions and millions of square feet of empty office space across the United States. So if somebody's offering you an office space at a discount, there's a reason. Robert, we're seeing a bunch of people try to repurpose the office space into multifamily residential, which isn't easy.
Right. Yeah. Yeah, and you probably know this, Russell. The guys that used to be renting out 40,000, 50,000 in the office space that have converted that down to 10 and 15 are actually fully occupied. The ones that haven't made that shift are in that situation where they need to sell and get rid of the property.
Yeah, we just actually had a deal that we restructured. So somebody brought us a deal. The bottom floor was all, office, and they were going to try to mix in some retail. And we couldn't get it to pencil. We changed it to all residential. It flies like a kite. It's amazing. Yeah. So right now, office space is just tough.
Yep.
All right. Listen, if you are ever going to start a business, right, and you're going to go into a retail space or anywhere else, understanding lease types is ridiculously important. I just helped a very close friend of mine. We got him a gross lease, which I haven't seen one of those in years. The landlord, in my humble opinion, didn't know what they were doing, which was great for me because I'm helping, right? Our job is to help our client. Essentially, a gross lease is this in commercial lending. And this is, by the way, why a lot of people love commercial as they get retired, because it's mailbox money. When you get all the way over to the right where it says true triple net, you don't have to do anything, right? But let's talk about a gross lease. A gross lease is what you would normally think about when you think about a residential lease. However, think about it this way, that the landlord pays for almost everything. The only thing that a tenant pays is their regular rent and probably their electricity, right? Maybe a couple other things you have to read very carefully through gross leases, but that's it. Now, the next one is called a triple net lease. That's where the landlord charges the tenant for what we call community area maintenance, right? Landscaping, keeping the area nice, potentially somebody to sweep the parking lot, like all of the community area maintenance. Taxes. So all the property taxes in the building get, they get divided up between all of the tenants, and those tenants all pay for the property taxes and insurance. Now, the difference between triple net and true triple net is, in addition to all of that, in a true triple net lease, which is what the commercial people really like today, they also have impound accounts, let's call them, or reserve accounts for long-term maintenance, like roof repairs, HVAC repairs. So essentially, the landlord is responsible for Zippo, right? And so if you're a retirement person and you have a beautiful commercial building and you have a number of tenants all on true triple net leases and you have a great property manager, you just collect money in the mailbox. Anything that you want to share on any of these, by the way, your lending as a borrower, if you own a building, is going to be severely impacted depending upon which one of these types of leases that you have, if you're looking to refinance or purchase. So the type of leases that are inside the building are very important when it comes to financing commercial.
Yeah, and if you get into a gross lease environment team, and Russell, you'll appreciate this, you lose massive valuation in the overall property value, no matter what the cap rate is, because you're actually ending up paying for those fixed expenses. And bankers and underwriters and lenders aren't huge fans of the full service stuff. They want to see triple net or full triple net. Much better way to go. And it has considerable, again, impact if you're the building owner on total valuation and where you could sell it, where you could list it. So it's definitely something to keep in mind. I didn't know full service was still getting signed up nowadays, Russell. So good job for you and for your friend, man. That's the way to go.
Yeah, it was our hitting facility for our softball team, and they grabbed me, and we did a great job. We have Matthew Stewart, my Monday, Wednesday, Friday friend, at the gym at 24 Hour with a question. What do you got, Matthew?
Hey, thanks, buddy. On the true triple net, you had mentioned management, and if the tenant's responsible for everything, why would you bring management in? What am I missing?
Well, I own a bunch of properties, Matthew, and management is terrible. I don't want to manage any of them. So on a true triple net, you pay for everything. Listen, even though the tenants pay for everything, somebody still has to call the roofer, right? And I don't want to call the roofer. I don't want to call the plumber. I don't want to call anybody. So, I have a number of doors. I was visiting one of our places the other day, and I didn't even know that there was a plumbing issue in one of the units. It's very nice freedom to have a property manager.
Yeah, and Matthew, it also depends. Like I own several buildings with single and double and triple tenants, where it's very easy to manage and you don't need a property manager. But to Russell's point, when you get in the 10, 15, and 20, you certainly don't want to be fielding calls at night when silly things happen, right? Just enjoy the check.
Yep. And I know I touched on this in the overview, but I thought I would run through it and then we'll do the math on it. Everybody gets fancy, right? I'll tell you, when you're buying a hotel, like let's say, well, they'll say, oh, what's the price per key, right? Well, that's fancy commercial lingo for the key is, let's say the hotel has 120 different rooms. They say 120 keys, right? That's fancy language. On apartments, it's price per door, right? Again, it's just understanding the lingo in commercial. And we'll talk about right now the actual calculation on cap rate. And all it really is, guys, is a return on investment. Yeah, Don, you have a question also?
Yeah.
Or a comment?
Well, no, a question. So a lot of folks might be thinking to themselves, gosh, I barely understand investing in residential. Going into commercial is above my pay grade with the complexities. Is there deals where they can get in with you or others where they could refer their client in, maybe instead of taking down the whole deal? Kind of like I think of Bellwood, how they bring together maybe 100 investors to take down a luxury property. So can I take my client into I may not get the commission or something, but can I get a listing and sell a rental for them that they could then exchange into something like this? Or are there partnership opportunities is my question.
Yeah, so there are partnership opportunities, and we can connect folks with those. Most of those go from small syndication to large funds. All of those folks are regulated, and their groups have buy boxes that they're allowed to operate in, right? So you know exactly what's being done with the money that you invest in. As you know, there's also, DSTs. If you're coming out of like a 1031 exchange and you want to invest in commercial real estate, the DSTs are a good choice. Us real estate agents don't make a lot of money, but I did put, some of the older folks in my own personal family into those because those are mailbox money. So you would pick like a category, call it like student housing or Robert's favorite, right? Medical, the medical industry or whatever it is that you wanted to invest your money in. You think that's going to do well, and you'll get a return on your investment, like a cap rate return. And then you participate in some of the equity when they sell. So those are out there. If somebody wants to participate in those, great. For us as real estate agents, yeah, I mean, you can do a non-official syndication where you can put 2 or 3 or 4 people together, right? As partners, you got to be careful because if you're putting them together, you have some liability as an agent or a broker. But then you have the opportunity to make a nice commission on those. So what I want to try to do today is make you not afraid, right? Don't be afraid by the end of the day. It's not as fancy as it sounds. It's not as hard as it sounds. And the way to learn is to start getting involved in one of them and then take a partner. If you're doing a buy, reach out to myself or Robert. We'll help you finance it. And then as we're helping you finance it, we'll make sure you don't screw up. Like, just tell us you're new, right? And we'll help you all the way along the way to make sure that you represent your client well. If you're going to take a listing, then you're going to want to take a partner that's sold commercial real estate before, because you want to position it correctly. Like right now, I'm selling a number of apartment complexes. And when you're selling apartment complexes, right, they want to see T12s, which again sounds fancy. It's only the trailing 12 month financials, right? They want to see the current balance sheet on the property, and they want to see the rent roll, right? Those are three of the big pieces on selling a apartment complex. And then they want to understand what the cap rate is, right? So it's not super hard. I know it sounds like a little bit more complicated. We'll walk you through it. It's not that hard. So let's talk about cap rate again, because this is valuation. You heard me talk about that situation before.
Russell, can I jump in a quick second?
Yeah, absolutely.
Just to touch on Don's comment, and to Russell's point, commercial real estate is very similar to resi stuff. And as you get touched on it, you'll get more comfortable with it. But Don, to your question, I'm building a sports complex with the NHL here locally. Tanger's asked me to build a bunch. I've got local investors. I take on minimums. But there are local investors in each market that would entertain that. And a lot of local investors that are not asking for a PPM, if you refer a client in, will pay you a 2% referral on that kind of stuff. And I don't know if Russell, I'm not trying to get into deep detail on it, but there are often local opportunities for investors that want to learn the business, that live in your marketplace, that will get you an override because it's not a PPM and it's a much smaller acquisition, but they are out there specifically in local markets. So you guys are on the streets all the time. You may even run into it the more you start listening to the commercial environments and getting involved in the space. So I'll just leave it at that.
Yeah, thank you.
Yeah, and Don, what I can do too, Don, is my next round, I can maybe bring one of those guys on here that has a syndication if people want to talk, hear from one of those guys.
I think it'd be really interesting to actually have someone present their project to us.
Yeah, I will absolutely do that.
Yeah,
I'll do that next.
Even once a quarter, I think we could, if we're sort of mentally planning on, hey, our group is gonna have a good investment once a quarter that we could all team up and take down, or at least have the opportunity to. I think that'd be pretty cool.
No, that would be really, really cool. And yeah, let's talk about doing that. We could even do it ourselves as a group. Like you said, the people that come on the call most regularly, we all put in a couple bucks and we can take down some of these that make sense. All right.
You'll do your first value add, Russell. It'll make everybody a lot of money, man.
Right. And guys, this is how simple cap rate is. It is NOI divided by purchase price, right? It is not any more complicated than that. What is NOI? Net operating income. It is, simple, right? And I try to give you a little bit of what we're seeing in the marketplace right now. Let's say you were to buy something. I know a lot of you are from Northern California, right? So let's say we were going to buy something in a downtown Bay Area, let's call it like San Jose, where we know the appreciation is going to be crazy. It's a Class A building, national credit tenants, lower risk, lower yield. You're looking probably somewhere in the 4 to 5% cap range because, again, you're going to make money on appreciation. And now cap rate, net operating income, divided by purchase price, right? So it's operating income. It doesn't calculate the appreciation that you're getting. Also, because the risk is lower, you get a lower return, right? And so, I'm not going to read all these to you, but 6 to 7, a little bit more balanced risk, and then 8+, you can find some really good income producers. You'll hear people say, oh, man, I really like buying in Ohio. Yeah, you can buy in Ohio. It's great. You're going to get very little appreciation. So sorry for my Ohio folks, but you're going to get a beautiful return on investment because properties there are still very inexpensive. One of our funds out of Reno, believe it or not, buys a ton of property in Cleveland because Cleveland still has very affordable house prices and the rents are outstanding. So their cap rate is 10+. But they don't get a lot of appreciation. So when they get to sell off that portfolio, they're not going to make a ton of money from an equity position, but the return monthly is pretty nice. So we'll just go through the example just for a quick second so you understand. If your gross rent was 10 grand a month, right? Your annual gross rent would be 120 grand. If your operating expenses were 30 grand, which is fairly characteristic of a decent building, if you're going to run like residential real estate multifamily, you're probably going to be closer to 35%. So you're going to be, 40 plus. However, a nice building, an operating expense of 30 grand is very reasonable. Your net operating income would be 90. If your purchase price was 1.125, your cap rate would be 8%. And again, you're just taking your net operating income and you're dividing it by your total purchase price. Cap rate. You all are now experts in cap rate, and it is not that complicated, right? By the way, if you had a true triple net building in this same scenario, true triple net, right, where you had nothing, right there where you see it says operating expenses, it would be zilch, zero, nothing, zero, right? So you would be running a 10 plus cap rate on this because you would have 120,000 over 1.125. Make sense? Hopefully the answer is yes. All right. This is where I'm going to turn it over. And by the way, I didn't tee up Robert, but I know he's an expert. So we have what are called DSCR loans. They are a fantastic loan in the marketplace because they kind of even the playing field. It's based on income. And Robert, I took a little liberty here, and I know I showed the deck with you early, but DSCR stands for debt service coverage ratio. So what people are doing when they're going to apply for a loan with a DSCR, they're saying, hey, we have more than enough income to cover the money that we're asking for. And if Robert, if you want to take this one, because I know you're the financing expert, I will hand it off.
Yeah, so you're referring to DSCR in the commercial space, not in the DSCR Resi acquisition. Is that fair, Russell?
You know what? And you can touch on both if you would like. Why not?
Let me just start in the commercial space. Most lenders have a baseline of debt service coverage somewhere between 135 and 140 as a very bare minimum to get loan approvals to make sure the client is sustainable and can afford the monthly installments. So in general, commercial lending looks at a minimum baseline of 145. What's interesting in the commercial space and the development space, and very exciting, and Russell's fully aware of this, when you go to push DSCR in the development space, you're able to use a third-year pro forma number. They actually let you go out 3-4 years on stabilized. So in the construction space, you can get very creative with the DSCR. In the stabilized asset space, you've got to be very sharp in your numbers. That's one of the reasons most people love HUD, because HUD allows you to go down to 1.15 in debt service. And just give you a great example, I was actually working on a $100 million deal, multifamily deal in Arizona. The sponsor got an approval to $68 million through Fannie because their DSCR coverage, it starts at 135. Well, I pushed him over to HUD instead of him getting 68 million, and the numbers don't matter. It's relative. I didn't throw a large number at you to throw a large number at you, but we were able to get him 81 million instead of 68. And he looked at me like my head was cut off. Robert, I can leave $12 million in my bank account. So understanding what lender and what asset class allows the lower leverage deals, specifically multifamily, and HUD is one of the easiest ways to get in the market and lowest leverage from a debt service coverage perspective. Now, I asked Russell just now, is that the Resi side? I'm sure most of you guys in the Resi space work with DSCR loans on the residential side. We have lenders on our platform. Most of you have probably touched these that will let your clients go buy a residential unit 1 to 4. Some of our groups go way above it and basically just base your loan approval on DSCR without necessarily income, experience, any of that fun stuff. So depending on what asset class you're looking at and what you're trying to push, DSCR has a very large impact and in some cases not as much. But in the commercial space specifically, you want to figure out how to get your clients specifically stabilized above 145. And a lot of the time, I've seen deals that are not triple net not make the cut because they've factored in the tax bill. It has a very, very big impact on everything from valuation to qualification and getting loans done in the future. So from a DSCR perspective, you want to be pegging somewhere around 1.45. On the construction stuff, you can actually go out on a 3-year pro forma and get those to the settlement table and really drive your debt service coverage up, which the lenders love a lot more. And I'll give you a great example. I closed that large hotel deal for $195 million. The sponsor came to me with an $80 million lower loan amount. When I grabbed his pro forma and looked at where the debt service was on a 3-year pro forma, I said, you guys have done this all wrong. I went back in, reworked the pro forma. We got him an $80 million lift, call it a 20, 30% lift. And size doesn't matter again. I'm going to just leave that comment out there. But again, when it comes to construction loans, you can get very creative on your pro forma and how you bring numbers in, as long as you can substantiate. I'm sorry about that. It came out the wrong way. As long as you can substantiate your pro forma, you can actually get a lot more done based on pro formas, as opposed to buying an asset that's stabilized, but not quite making it to your debt service coverage. And that's where a lot of developers do very well. Some do a really good job in showing where they're planning on landing stabilized. Others come in and send us files where the debt service coverage at year 3 is below 1. And those dogs just won't hunt. So it's important that you understand debt service coverage, wanting to be above 1.45. And I'm hoping that's what you were looking at, Russell, in regards to above the 1.25. But again, understanding if you've got low debt service coverage and you're in the multifamily space, HUD is always a very, very good option. You just got to make sure your client qualifies.
Will you jump on it?
Yeah, set it up.
No. I will be on in a minute. Will you? Yeah, let them know. Sorry. I have too many meetings at the same time in the mornings. my own problem.
Any questions on debt service coverage? This is one of those kind of stop, drop, and roll moments often in the lending space, but as long as, Russell's got the 1.25 up there, lenders do look at it. When you're going to come in low on the debt service coverage, you have to have compensating factors like good liquidity, strong sponsor activity, good schedule of real estate owned. Limping in as a new investor or trying to get into the space at a 1.25 coverage often results in a turn down unless you bring a strong sponsor in with you. But you want to see stuff above 1.5. Once you get into the 2s, you get a lot more love from lenders. Rates get a lot better. So it's really just a question of, as you can imagine, right? If your payment's $1 and you're making 2, it's a lot easier to service the coverage than you making $1.25. So it's really just a question of what output is based on the income that's generated by the property.
Hey, Robert, you mentioned pro forma, and I'm sure, some people are like, well, what goes into a pro forma? What does that look? Because you said you reworked it. So It's like, well, how does that, what does that look like? And how is that,
Yeah, so just to kind of touch on the basics, the hotel operator gave me everything from income to expenses, and the net income was at a number I wasn't happy with on the debt service coverage. So I asked a couple questions, Matt. What's going on with, in the hotel space, wedding venues are massive. I've been involved in the hotel development. I'm like, what's going on with the wedding development side? Oh yeah, we got massive amounts of commitments. I'm like, it's not in your pro forma. So talk to me a little bit about it. We added 19 million annualized in wedding space. And then when I went and looked at the value of his ADR rates, what his income was on the top line, we were able to increase the room rates per night by, I think it was $350. So between the wedding activity and adding average daily room rate, a 25% lift, and then we justified it. The hotel has got Winter Olympics coming at it. It's got the 2 sports complex pushing it. So you got to find factors that support your pro forma. But as long as you can do that and make sense of the income lines that you have on the pro forma, your bottom line and net income will make sense. And these lenders want to believe the story. And that's the nice thing about the development space. You can often get away with better loan approvals than you can in stabilized on a lease that's not triple net because it's driving down your debt service coverage. But the long story short of it is, if you want to be at a 1.25, you need a very strong sponsor and good liquidity. Getting above that, you can get away with different compensating factors. I don't know. Does that answer your question?
Yeah, I think so. I mean, it's interesting to me that they missed out on quoting income on weddings when they're performing them. Unless you're future pacing, like these are booked, we haven't collected any money yet. This is what we're anticipating, right? And that's what they're lending on. Is it doesn't have to go forward that way. Maybe they don't bring in 19 million on the wedding, but that's what we thought we were going to get.
Yes. Right. And let me answer that question. And Russell gets in front of this with Michael all the time. You would be surprised what sponsors send us sometimes, which is where we come in, right? As the trusted advisor, candidly, I look at stuff and I go, what the heck are you guys doing? Without saying that, I mean, there are some very obvious things in multifamily hotel, the asset class you're looking at. So you would be shocked with some of the stuff we see on the, like I get deals all the time. They want 50 million, debt service is below 1 point. I'm like, you guys clearly didn't think through this, but Matt, it happens more often than not. And Russell's point, if you do not go into the game with the right A team around you, who understands what they're doing. Look, I jumped onto the platform last year, not in development. This is a true story, team. And I need to be careful, I guess, how I respond to my next statement, but I pushed over $4.5 million through the platform and made a ton of money jumping into the commercial space when all I was doing was development at the time. And it's really just a question of making the decisions sometimes, asking the right questions, but partner with the right team that will bring you along the process in 3 to 4 months. There's no reason you guys can't be doing 2, 3, 4, and 5 units a year. And those are very large volume deals more often than not compared to the Resi stuff, right? If your average loan size is 15 million versus 1.1 million, I don't need to tell you what 2% of those numbers look like, right? So they add up very, very quickly. You know, I closed a very small SBA loan. The client was struggling with it. That's one of the other nice things about our space. It's $350,000. He offered me $45,000 to close the loan because nobody else could get it done. I said, that's a little too much. I'll take 25, but it's relative in scale, right? You can still do a lot more in the commercial space often because some of these things are not as cookie cutter as, does the client qualify? Can I get them a loan in the Resi space? There's a lot more going on from a qualification perspective, but get the right team in place and start. You guys are on the street every day of the week. You get in front of this stuff. Don't be shy to get involved and pull us in if you need it. Lots of opportunity.
All right, we're going to wrap it up. I apologize. I didn't realize I was double booked too, but here's the key. Know your asset classes. We walked through a bunch of those. Understand lease structure, super important when it comes to filling these spaces with tenants. And again, there's so many commercial spaces that you may not have a lease, and the commercial is everything. And then understanding cap rate and DCR. This is all a good starting place. But to Robert's point, bring us deals. And the reason that I want to share this with you, this is a production call. If you're used to doing $300,000, $400,000, $500,000, $600,000 houses and you do one $5 million commercial transaction, that's not a big commercial transaction, right? And you're probably going to triple the income that you're going to make this year with one transaction. So that was my objective today, was to get you not afraid, get you asking the questions, having you educated when you have conversations at, parties or movie theaters or restaurants or whatever, making new contacts and making more money. So if there's more questions, we'll take them. That's about all I have, unless anybody else has anything here. And I'm going to run to my next meeting, so I apologize.
Yeah, thank you. That's good.
Awesome. Tom, you want to take us away with your favorite? Or did Tom go skiing?
If you guys got snow in Tahoe, he's probably listening.
Yeah, he's at Sugar Bowl. All right, so you have your inspiration. Now it's time to put in the perspiration. We will see you next Wednesday at the Atomic Habits. From now until then, make sure that you're talking to as many buyers and sellers as you can every day. See you guys next week.
Thanks, Russ.
Robert, thank you.
Thank you, Robert.
Care, guys. My pleasure.
Thanks, Robert.